Let's start with the basics. When most people hear real estate, they think of buying a house to live in. But real estate is so much more than that. It's land, buildings, and everything permanently attached to them. Think of it as owning a piece of the world. Real estate comes in different flavors. There's residential real estate, that's houses, apartments, condos where people live. Then there's commercial real estate, office buildings, shopping centers, warehouses where businesses operate. You've also got industrial real estate like factories and manufacturing plants. And don't forget about land itself, empty plots that could be developed later. Here's what makes real estate special: it's tangible. You can touch it, see it, walk through it. Unlike stocks that exist only on paper or in computers, real estate is physical. And here's the kicker: they're not making any more land. The supply is limited, but the population keeps growing. Basic economics tells us what happens when demand increases but supply stays the same. Think about your neighborhood. Has it changed over the past 10 years? Have home prices gone up? That's real estate appreciation in action. While stock markets can crash overnight, real estate typically moves more slowly and steadily. It's like the tortoise in the race, slow but often wins in the long run. Now, let's talk about why real estate has created more millionaires than almost any other investment. It's not just one reason, it's several powerful forces working together. First, there's appreciation. This means your property becomes more valuable over time. Let's say you buy a house for $200,000 today. If it appreciates at just 3% per year, it'll be worth about $240,000 in 6 years. That's $40,000 you made just by owning it. But here's where it gets interesting. You didn't need $200,000 to buy that house. This brings us to leverage. In real estate, you can borrow most of the money you need. Let's say you put down $40,000 and borrowed $160,000. When that house appreciates to $240,000, you made $40,000 on your $40,000 investment. That's a 100% return on your actual money invested, not just 20%. But wait, there's more. If you rent out that property, you get monthly cash flow. Good rental properties can generate $200, $500, or even $1,000 or more per month after expenses. That's passive income, money coming in while you sleep. Over 30 years, that rental income could total hundreds of thousands of dollars. The tax benefits are huge too. The government lets you deduct mortgage interest, property taxes, repairs, and even depreciation. Depreciation is particularly sweet. You can deduct the cost of the building over 27.5 years, even if it's actually going up in value. It's like having your cake and eating it too. Here's a real example. Sarah bought a duplex 5 years ago for $180,000. She put down $36,000. Today it's worth $240,000. She's made $60,000 in appreciation on her $36,000 investment. Plus, she's collected about $800 per month in rent after expenses. That's $48,000 over 5 years. Her total return: over $100,000 on a $36,000 investment. That's the power of real estate. Different ways to make money in real estate. Real estate isn't just about buying and holding. There are many strategies, and different ones work better for different people and situations. Let's start with rental properties. This is probably the most common real estate investment strategy. You buy a property, rent it out, and collect monthly income. The key is finding properties where the rental income covers your mortgage, taxes, insurance, and maintenance, with some left over for profit. Look for properties in growing areas with good schools, low crime, and job opportunities. These attract quality tenants who pay on time and take care of your property. Then there's house flipping. This is buying a property, fixing it up, and selling it quickly for a profit. Sounds simple, but it's actually quite risky and requires a lot of work. You need to understand construction costs, market values, and timing. Many beginners lose money flipping because they underestimate costs or overestimate the selling price. If you're interested in flipping, start small and learn the business thoroughly. Real estate investment trusts, or REITs, are another option. These are like mutual funds for real estate. You buy shares in a company that owns and operates income-producing real estate. You get dividends from the rental income without having to manage properties yourself. REITs are great for beginners because you can start with just a few $100s and you don't need to deal with tenants or repairs. Wholesaling is a strategy where you find great deals and sell them to other investors. You put a property under contract, then assign that contract to another buyer for a fee. You never actually own the property, but you make money by bringing buyers and sellers together. This requires less money upfront but more time and knowledge of the market. Real estate crowdfunding platforms let you invest in real estate projects with other people. You might invest $1,000 in a project to build an apartment complex, and when it's completed and sold, you get your share of the profits. It's like being a silent partner in real estate deals. Commercial real estate is for more advanced investors. Instead of houses, you're buying office buildings, retail centers, or industrial properties. The numbers are bigger, both the potential profits and the risks. Commercial properties often have longer lease terms, which can provide more stable income. Land investing is buying empty lots or larger parcels of land. You're betting that the area will develop and your land will become more valuable. This can be very profitable but requires patience and good research about development trends and zoning laws. How to get started? So, you're interested in real estate investing. But where do you start? Don't worry, everyone started somewhere, and you don't need to be rich to begin. First, educate yourself. Read books, watch videos, attend local real estate investment meetings. Knowledge is your best protection against making expensive mistakes. Learn about your local market, what neighborhoods are growing, what rental rates are common, what types of properties are in demand. Next, get your finances in order. Check your credit score and work on improving it if needed. Lenders look at your credit when deciding whether to give you a loan and what interest rate to charge. A good credit score can save you thousands of dollars over the life of a loan. Start tracking your income and expenses so you know how much you can afford to invest. Save money for a down payment. For investment properties, you typically need to put down at least 20 to 25%. Don't have that much. Consider starting with a duplex or small apartment building and living in one unit while renting out the others. This is called house hacking, and it lets you buy with as little as 3 to 5% down because it's considered an owner-occupied property. Build your team. You'll need a good real estate agent who understands investment properties, not just regular home sales. Find a lender who specializes in investment property loans. Connect with a reliable contractor for repairs and maintenance. Get to know a good accountant who understands real estate taxes. Having the right team can make the difference between success and failure. Start small and local. Don't try to buy $1 million apartment complex for your first deal. Look for a single-family home or small duplex in a neighborhood you know well. You want to be able to drive by your property easily and understand the local market. Run the numbers carefully. This is crucial. You need to know all the costs involved, not just the mortgage payment, but also property taxes, insurance, maintenance, vacancy allowances, and property management if you hire someone. A good rule of thumb is the 1% rule. The monthly rent should be at least 1% of the purchase price. So if you buy a $100,000 house, it should rent for at least $1,000 per month. Don't get emotional about your first deal. This is an investment, not your dream home. Focus on the numbers and the potential return on your investment. The pretty house in the nice neighborhood might not be the best investment if the numbers don't work. Common mistakes to avoid. Learning from other people's mistakes is much cheaper than making your own. Here are the biggest mistakes new real estate investors make. The first mistake is not doing enough research. Some people get excited and buy the first property they see without understanding the neighborhood, the market rents, or the true condition of the property. Always research comparable sales and rental rates. Drive through the neighborhood at different times of day and week. Talk to neighbors and local business owners. Underestimating costs is another big mistake. Many new investors only think about the mortgage payment and forget about property taxes, insurance, maintenance, vacancy periods, and property management. A good rule is to budget at least 1% of the property value per year for maintenance and repairs. Factor in vacancy periods. Even good properties can sit empty for a month or two between tenants. Over-leveraging is dangerous. This means borrowing too much money relative to your income and assets. Real estate can be a great investment, but it also involves risk. Don't put all your money into one property or stretch yourself so thin that one vacancy could ruin you financially. Not screening tenants properly can lead to major headaches. A bad tenant can cost you thousands of dollars in lost rent, damage to your property, and legal fees. Always check credit scores, employment history, and references from previous landlords. It's better to have a property sit empty for an extra month than to rent to someone who will cause problems. Trying to time the market perfectly is impossible. You can't predict exactly when prices will go up or down. Instead of waiting for the perfect moment, focus on finding good deals that make sense at current prices. Good real estate investments can work in both rising and falling markets. Market analysis and location. Location, location, location. You've heard this before, and it's true. But what makes a good location for real estate investment? Look for areas with job growth. When new companies move to an area or existing companies expand, they bring jobs. More jobs mean more people moving to the area, which increases demand for housing. Check local economic development websites and news sources to see what businesses are coming to your area. Good schools matter, even if you're not buying in school districts for your own kids. Properties in good school districts tend to appreciate faster and attract more stable, long-term tenants. Families with children are often willing to pay more for good schools. Transportation and infrastructure are crucial. Properties near major highways, public transportation, or airports tend to be more desirable. Look for areas where new roads, transit lines, or other infrastructure improvements are planned. Low crime rates attract good tenants and help properties appreciate. Check local crime statistics and talk to local police about neighborhood trends. A property in a high-crime area might seem like a bargain, but it could be difficult to rent and maintain. Population growth is a key indicator. Growing populations mean increased demand for housing. Look at census data and local planning documents to see where growth is happening and where it's expected to continue. Neighborhood amenities matter too. Properties near shopping, restaurants, parks, and entertainment venues are more attractive to tenants. But be careful. Some amenities like bars or concert venues might be attractive to some tenants but problematic for others. Watch for gentrification trends. This is when run-down neighborhoods start improving, often bringing in higher-income residents. Getting in early on gentrification can be very profitable, but it requires careful research and timing. Don't ignore the numbers in favor of gut feelings. A neighborhood might feel great to you, but if the median income is too low to support market rents, or if there are too many properties for sale, it might not be a good investment. Financing your real estate investments. Understanding financing is crucial because most real estate investors use borrowed money to buy properties. Let's break down your options. Traditional bank loans are the most common. For investment properties, you'll typically need 20 to 25% down and have good credit and income. Banks want to see that you can afford the mortgage payments even if the property sits empty for a while. Shop around. Different banks offer different rates and terms. Portfolio lenders are banks that keep loans on their books instead of selling them. They often have more flexible lending criteria and can work with investors who don't fit traditional bank requirements. These relationships can be valuable as you grow your portfolio. Hard money lenders offer short-term loans with higher interest rates. They're useful for flippers or when you need to close quickly. The loans are typically for 6 to 12 months and are based more on the property value than your creditworthiness. They're expensive but can be worth it for the right deal. Private money comes from individuals rather than banks. This could be friends, family, or other investors. Private lenders often offer more flexible terms and faster closing times. Always document these loans properly with written agreements. Owner financing is when the seller acts as the bank. Instead of getting a traditional mortgage, you make payments directly to the seller. This can work when sellers are motivated and don't need all their money upfront. Partnerships can help you access more capital. You might partner with someone who has money but doesn't want to manage properties, while you handle the day-to-day operations. Make sure partnership agreements are written and clear about who does what and how profits are split. Your debt-to-income ratio matters. Lenders want to see that your total monthly debt payments don't exceed a certain percentage of your income. As you acquire more properties, this can become challenging. Some investors form LLCs or corporations to help separate their personal and investment property finances. Interest rates significantly impact your returns. A 1% difference in interest rate can change your monthly payment by hundreds of dollars. When rates are low, it's easier to find profitable deals. When rates are high, you need to be more selective. Remember, financing is a tool. Used wisely, it can accelerate your wealth building. Used carelessly, it can lead to financial disaster. Always have a plan for how you'll pay back any money you borrow, and don't rely solely on property appreciation to make deals work. Real estate investing isn't a get-rich-quick scheme, but it can be a powerful way to build long-term wealth. Start with education, be conservative with your first deals, and always remember that every successful real estate investor started with their first property. The key is to start, learn from experience, and keep improving your knowledge and skills. With patience, proper education, and careful planning, real estate can provide both passive income and long-term appreciation, helping you build the financial future you want. Thanks for watching. Kindly like and subscribe.